Hi, my name's Leah Anderson and it's my pleasure to present this next session in our Small Business Big Impact program. Today we are joined by Peter Hollingsworth of the Business Centre, who'll be presenting a session on demystifying your financials for your small business. With a vast and varied career in retail, franchise and owning and operating several of his own businesses, Pete is the go-to guy when it comes to training for people looking at starting their own enterprise. Peter has conducted our new Enterprise Incentive Scheme training in the past 7 years and has coached countless local entrepreneurs through the muddy waters of beginning in business to lead them to run successful operations of their own. Peter has personally organised, planned, delivered and moderated training programs catering to all levels of learners over the last decade and a half. He's also owned and operated several small businesses over this period and developed a national franchise chain from scratch, and as such is strongly empathetic to the challenges and processes required around business startups, survival and growth. Pete has a particular focus on strong financial management and has built a coaching methodology around a sound marketing principle, which aims to deliver repeat business and drive referrals. This session is proudly sponsored by Business Port Stephens.
Good morning and thanks for the introduction. My name's Peter Hollingsworth. I'm a business advisor at the Business Centre in Newcastle, and it gives us great pleasure today to be able to join you at the inaugural Small Business Big Impact Expo. The topic I'm talking about today is around financial foundations, and we'd like to explore some of the options around for you to take control of your business's financials. Particularly around bookkeeping, but also budgeting, taxation planning, and most importantly, perhaps how to safeguard your business, make it future-proof. So as we get into that, I'll be online live on the platform during this presentation. So if you've got any comments or questions, use the chat function. I'll endeavour to get back to them today straight away, or if not, then certainly I'll give you my contact details in just a moment. I'm just going to share the screen right this moment, in fact, and my details will be there on the screen for you. Phone number at the Business Centre and also via email. So with no further ado, let's have a look at the topic that we're going to be talking about today. I'm going to discuss taking control of your financial record keeping. One of the, all of the reasons rather why you should have a good set of financial accounts, what it means to compile those, what it means to keep them efficient and up to date, and how you might be able to run your business on that basis. We're going to have a look at some financial modelling that we might be able to interest you in, particularly around preparing a sales mix budget. One of the key things around doing that is understanding your pricing. So I want to take you on a little bit of a pricing expo, understanding your variable costs, those costs that are directly involved in generating the revenue streams in your business. Also going to have a look at how we might prepare a cash flow forecast, and particularly looking at fixed costs, the impact of the GST and the tax liability on your business's cash bottom line, how those things might affect your cash flow. Then finally, we're going to have a look at a couple of profitability and management ratios that are very easily attained from the information that's already provided within your financial data that will help you run your business more effectively, see trouble before it looms, and take corrective action before we get to that point. So moving on, taking control of your financial record keeping. When we were back in the days of the paper BAS that we needed to lodge before we had all the online portals and so on, there was a little box that you had to fill out down the bottom, I remember, that said, how long did it take you to fill out this form to get us all the information to complete your BAS? And you talk to people about it and they say, bloody hours, the 6 hours of my life I'll never get back doing this work for the tax office. I would suggest to you that realistically, that should only take you a couple of seconds, however long it takes to go into your accounting package, press the button that says BAS report, and it's done. The reason for that is I think we should be using the information that we've got at our disposal to help us run our business anyway. Doing our compliance work with the tax office should simply be that, just pressing a simple button at the end of it all. Why should we do this? There's many benefits, of course. Maximising your chance of business success would be right at the very top, because unless you know where this thing's going, unless you know how to be in control of your business, you're just hanging on for grim death, going along for a ride. By understanding your financials, you can grasp that control back and steer the ship where you want to go. Understanding your financial record keeping will let you know, obviously, how much money you've got available at any one time, how much money is owed to you by your customers who are yet to pay you, which accounts you have to pay to your suppliers and other creditors, monitoring and controlling your business's overheads, not letting your cost of goods and services get out of control. And ultimately, this will lead to an understanding of profitability. Not only where your profit centres lie, but what might be the reason for poor performance. All this can be found out through your record keeping processes and understanding a little bit of the data that's generated as a result of that. You'll be able to compare your business against itself over time to observe trends, but also to other businesses in your industry. The ATO has a business benchmarking site where you can compare what you do against other businesses in a similar industry of a similar size and see where there might be grounds for improvement. Obviously, you can see the results of decisions you might have made in terms of increased profitability or return on investment and the like. And having a good set of figures, a good set of books will help you as you apply for finance or other negotiations with your bank manager. Making insurance claims would be another reason why you need to have your books up to date and complete. I've seen evidence of that firsthand in recent years after some of the catastrophic storms that we've had around the place, where business people have needed to seek assistance through their insurance policies. And part of that is to demonstrate, this is the level of profitability we had, this is our records, we might need to make a claim on this basis. It can also tell you, obviously, how plant and equipment is performing, the return on investment, return on assets. And obviously, when you get to that point where you need to divest or sell your business, you'll have a complete and honest set of accounts that can very much aid in valuation. By the way, did I also mention you'll be able to comply with the ATO? Just a small point, but obviously having a full set of books that's complete at any one point in time will assist you no end with doing that, and particularly if you need to be audited or have any other intervention with the tax office, it just makes that process so much easier. I want to move on now and talk about developing some sales mix and cash flow forecasting. But to understand that, and before we do, I just want to take us through a couple of scenarios around pricing. Pricing is probably a topic that's better handled in a marketing sense, but it very much has an impact in finances as well. And I want to introduce a couple of concepts here. We're going to develop a standard profit and loss overview in which we've got sales, cost of sales, sales less cost of sales gives us gross profit. Then we've got overhead expense recovery over the course of a trading period, such as a year, that ultimately results in a net profit figure. So if we look at this left-hand column here of a standard basic little retail type business, I guess, it's buying and selling stuff, so it's got a cost of goods of 30%. So for every $100 in revenue, there's ultimately $15 of profit to the business at the bottom line. That's probably typical of many small retail type businesses, particularly around hospitality and so on. That would be a fairly well run business, I would think. I want to explore what happens when someone comes in and says, oh, what's your best price? Can you do me a discount? Well, what happens is this. Generally speaking, the discount comes off the normal sell price. So revenue drops from, in our case, from 100 down to say 95. Just a small discount, 5%. Wouldn't even notice it, right? Well, the problem with that is that whilst our revenue drops, our cost of sales doesn't drop. It still costs us the same amount of money to buy our stock or to produce our goods or whatever. So what in effect happens is our gross margin drops from 70 down to 65%. The unfortunate thing is, though, that the expenses stay at the same level again. You can't go to the landlord and ask for a discount simply because you've given a discount to one of your customers, or you can't go to your staff and say, would you like a pay cut this month because I've been discounting our product? They'll probably politely say no. What then transpires is that our net profit has, instead of being at a level of 15, it's now dropped to 10. That represents a 33% reduction in net profit, just by a 5% discount. What's the alternative? I'd suggest we consider value adding. Would I be so bold as to think that you might have heard the phrase, would you like fries with that? Or would you like that in a meal deal? So why do organisations like McDonald's and so on offer these upsell or these bundle opportunities? This is in effect what they're doing. By not giving a discount, but saying, look, I can't give you a discount, but I'll take something off the upsell. So I'm going to put a bundle together that might be worth, say, 120, but you can have that for 110. So we've taken our sales revenue from 100 to 110. Consider the 100 might be the burger. The 110 is the burger with the fries and the drink. Our cost of goods actually goes up for that because this would have 120 worth of actual value. So at that same 30% ratio, our cost of goods would actually be 36. But that still leaves us with more gross margin. Given that our overheads stay at the same level of 55, we're actually now, by keeping full margin in our first product, making a recovery of our direct costs in the upsell, we're actually making more net profit at the end of the day. In fact, from 15, we've gone to 19. That's a little bit over a quarter. So 27% up. So we've gone from a situation where we discount to try and keep our customers happy, and we lose our profit, get very close down to nil profit. We're only making 15 cents in the dollar anyway, so to lose a third of it, we're only down to 10 cents in the dollar. Why not value add and increase our profit? The customer's happy, they've got a great deal, and everyone's a winner. So in terms of understanding our sales mix, it's important to keep full value in every dollar of sale that we can possibly get. So I'd like to have a look now at some spreadsheets which we've developed, and I'll share another screen with you presently, where we're going to talk about developing a sales mix and developing some cash flow and taxation planning budgets, then do a little bit of analysis, financial management analysis around some of the information that we can find there. So I'm just going to go in and share an additional screen now, which is this spreadsheet, and I hope you can see that on your screen. I've developed a series of linked spreadsheets that develop initially a sales mix and then a cash flow forecast, profit and loss and balance sheet, which we'll work our way through quickly. So I've just made up a sales mix for a small hospitality type business. Think of a typical cafe that you might see on one of your high streets or one of the shopping centres. And we've determined that there's 4 different sales categories within this business. There are meals that they sell in-house, there are snacks, beverages, and perhaps takeaway meals. So in this little sales mix, we're going for a full year. So here's the calendar year of 2021. And we've determined that the sell price for our meals in-house is $30. We've also been able to work out through probably our trading history and so on, that actually costs us around about, say, $6.80 to produce that meal. So our cost of goods, our direct costs are probably $6.80 for every $30 in revenue. So just going to say that that'll remain constant on average across most of the year. Oops, we'll do that a different way. We'll make that there, and $6.80 all the way through there. So the only other quantity that goes in here is the typical amount that we would expect to sell. So starting off perhaps at last year's figures, or a figure that you might be familiar with, we can put in, say, 300 meals. In the month of January, we might do 300 covers in-house. Moving on through the year, we might expect a little bit of growth. We might go from 350, 360. As the months go on, it's starting to get a little bit cooler, so we might get a little bit more. These numbers too can become aspirational. You know what you might do, but this is now a budget that you can start planning for and aspire towards. So middle of the year, we might want to be doing 400 a month, 420. doing some effective advertising, promotional work, social media and the like. 480, maybe 490, and the last couple of months we might hit that, 500 target. There we go. So for that particular product, we're selling about $150,000 worth of revenue over the course of the year at a cost of around $33,000. So that's a direct cost of goods for that product or service. I've done the same already just to save a little bit of time with the other products that we've got. So snacks and beverages and takeaway meals. So all up, you can see the quantities that we're selling of each one of those. And when we get down towards the bottom here, we can see what our total monthly sales has been, $400,000 across the year. That's about 8,000 or so a week. Typical cafe would do those sort of numbers, I would think. And a cost of goods of around about a third of that by the look of it, so 30-odd%. The only other question to answer at this stage is, of that money that we sell, or the product or service that we sell this month, how much of it do we actually receive this month? So I've just put in a little calculation that says we get about 90% of it this month. There might be some wholesale accounts or some people that still haven't paid us, and we'll get that money next month, let's say. So I've carried that calculation on here, and that suggests that we've got some money that's on credit that we get in sometime after the time of sale. The rest of it's cash sales. So there's our sales mix forecast for the business. Very easy set of spreadsheets to do a projection on. So we've got sales volume, sale price, and cost of sales. Moving on, I want to have a look now at a cash flow forecast. So here are these same sales numbers that came in from the previous table. So that's all done for us, along with the direct costs. What we probably need to do now is fill out all this other information. And you'll notice these are fairly similar to a lot of the accounts that are already in your chart of accounts on your accounting package, accounting fees and so on. So let's just fill that out. We might have bookkeeping software. We might subscribe to Xero or MyOb. That might be $50 a month. And we do that every month. So you'd put that in there. And maybe in about July, you might go to the accountant, do your year-end stuff. That might be, say, $12.50 that month. Actually, I'll make that 1,200 for now. So you can go through each of the other categories. I've already pre-populated the majority of those to save a bit of time again, but we've got things like major purchases of plant and equipment. I think it was extended in the budget last night that we've got another couple of years of being able to get an instant asset write-off for larger capital items, so that's there. Maybe buying a couple of other pieces of equipment here or there. We might do some advertising on a regular basis. We might pay the power and energy bills when they fall due. So it's important to note those expenses in the month that they incur so that we get those hills and hollows of cash flow and try and estimate when they're going to occur, because you know some months we're flush with cash, other months it's desperation stakes. Cash flow isn't an even spread. Normally there are hills and hollows, and we're trying to forecast that. Some things though, like insurances, they're going to be the same amount every month most likely. You might lease some equipment and have some motor vehicle expenses. Again, they're your running costs, but you might have something like registration insurance occurring at a certain time in the year. Rent or leasing of property. You might have a little bit for repairs and maintenance that happens occasionally. You might go to Officeworks and buy some stationery or ink or something like that from time to time. Pay the phone bill, a little bit of web hosting and so on. Another one which we shouldn't lose sight of is our bank fees. So typically you might have account keeping fees, so $10 a month, but of that revenue that comes into the business, a lot of that might be on merchant facilities like credit card and the like. So you know that there's a fair fee, there's a couple of percent. So I've said here that maybe 80% of that amount of money comes in off a merchant facility, at which there's a 2% fee. So when you look at that, that's several $1,000s through the course of the year for this business, fees to the bank for receiving money on credit card. The other thing that we want to have a look at quickly is maybe our employee wages. We might have paid ourselves a wage within that, certainly our other staff as well. There'll be on costs associated with that. So I've put in here typically that we've got our sales, our wages linked to our sales level. As you know, we get busier, we're going to need more staff, obviously. But there's an overhead loading of about 15% to cover superannuation, workers' comp, and all those on cost and overhead associated with employment. So factor all that stuff in through there, and then the spreadsheet itself, the one that we've got here, takes care of the GST. It records the GST that we've collected in the period, the GST that we've paid on our supplies in that period, and tells us how much we need to remit on a quarterly basis. That, of course, impacts on our cash flow for those months when we've got to make our BAS payment, doesn't it? The other thing that this tells us is how we're accumulating money in the business's bank account through the year. These numbers here represent the expected closing bank balance. The last thing that we've got to do on this is have a look at what our tax rate is. We've allocated ourselves an amount of money that we're going to pay ourselves through the year as drawings. So that's coming out of the business bank account already. But we need to figure out how much tax we've got to pay on our profits in the business. And I'm assuming, for the sake of this exercise, that we're actually either a sole trader or we're a company taking all of our profits as wages, leaving nothing in the company. So what we've now got is a very simply constructed profit and loss projection, stating what our revenue is, the amount of credit sales that we've made within that, and cash sales, and our cost of goods, giving us a gross profit of 300 odd thousand. All these other things that we've factored in here, I've worked out over on this side a depreciation schedule based on some assets which the business probably owns, to give us a depreciation allowance that we can claim throughout the year as well. Ultimately, that factors down until a total fixed expenses, leaving us with a net profit. So a couple of key indicators here. We're able to see that for 100% of our sales, we've got 28% cost of sales, leaving us 71% gross profit. At the end of the day, we've got $54,000 net profit after depreciation, which represents about 13.2% of sales. So what we need to do quickly is calculate what our tax liability is going to be on that. So we've put down here that we're paying ourselves $36,000 in wages as drawings. The business has $54,000 in pre-tax profits. So we need to put that into our published tax scales. Now, I've prepared this before the budget figures from last night. That still has to go through and be ratified in the Senate, obviously, and pass into law. So these are the tax scales as they were, probably not as they are going to be, but they're fairly similar. So the personal tax scales, the amount of money that we're being taxed within each bracket is added up here, and then overall we can determine that on our 36 and 54,000, so our 91,000 all up, our instalment rate is probably something like 5%. So that's the amount of tax we need to pay. That represents 5% of our total turnover, and that's our instalment rate that the tax office would give us. So that instalment rate then goes back into the previous table at that location there to work out our tax amount that we need to put aside every quarter to pay our bills. Very quickly, we've only got a few moments left. We've then been able to construct a pro forma balance sheet, which picks up the assets that we've got, the cash, debtors, stock on hand, and so on, and the amount of money that we owe our creditors, presumably, or primarily in this case, the tax office. We've got written down values of our assets to give us total fixed assets, so that all up, we've got an amount of assets and liabilities that gives us some form of net equity in the business, represented by what we put into the business or had been accumulated over time, plus the profit reserves from this trading period. So that gives us our net equity. So very simply, from a fundamental set of forecasting sales mix based on pricing, projected volume and direct costs, and then a cash flow forecast which looks at all the expenses flowing out of the business at various times of the year, we're able to put together a pro forma profit and loss and balance sheet. There's a couple of key ratios that we can then use to help us run the business. The first one I mentioned before is our gross profit ratio, 71%. That says that on average, out of every dollar of sales, there's 71 cents available for us to pay the overhead expenses in the business. That's a key figure to monitor on a regular basis, as is the net profit ratio. 13 cents out of every dollar is our net profit before tax that we're able to take out of this business after wages. So that tells us something about our profitability. Some other things that we can use though, one of them comes from the balance sheet. It's called the current ratio. It's looking at the relationship between the money that we've got in the bank, our stock, and our receivables compared to the bills that we've got to pay. In this case, it's to the tax office. We've got 48 grand. They want 14 of it. So we're 3.3 times to the good. We've got 3.3 times more than we need. If we take out our stock, because it's not as easy to sell stock as just go to the bank and get cash, we've got 2.3 times. Very quickly, another couple of ratios that we can look at is our accounts receivable. The amount of credit sales that we do, 37,000 in the year, divided by our accounts receivable, which is on our balance sheet, our accounts receivable, 4,500. That means that on average, we're offering 43 days credit. That's possibly too much. That might be a measure that we can try and get down to a more manageable level, particularly if the credit we're offering is on 7-day terms. One last one, very quickly to finish, is our stock turn ratio. You look at your cost of goods sold, which is 117,000, divided by the inventory that we're carrying at any one point in time. So there's our stock, 14,000. That represents 45 days. So we're turning our stock over every 45 days. We're able also to determine the point at which we break even, where there's neither a profit nor a loss. That happens several months into the year when our sales hit $340,000. So that'll do us. We're just about out of time. Really enjoyed the time with you on this occasion. I'll stop sharing this now. And I'd encourage you to give us a call at the Business Centre, get in contact with me if you need any further advice. I'll look forward to hearing any suggestions or questions that you might have. Thanks for now. Talk to you later. Bye.
Thank you, Peter. That was fantastic, and we appreciate your time contributing to the growth of small business in Port Stephens. Peter will be available for one-on-one meetings all day today. So just pop over to the meeting hub and catch up with him at a time that's convenient. We'll see you soon in the next session. Thank you.